Thank you for watching. Welcome back to Fifth Investments with another video. Today we are going to simplify trading, simplify investing, especially for those people who are business professionals or business owners or work 9 to 5 that don't have the time to day trade or short-term swing trade throughout the week. Now, this is literally the most simplified version of a trading strategy that you can get. First rule is never go all in. And I say this because you never want to go all in on the first time. Just in case it continues to dip, you want to be able to add more. So if you only have $1,000 to invest in a stock or your favorite stock or whatever it is, maybe start off with 300 just in case it dips. Then you can go 500, and now you have a small amount left over just in case it goes lower than your original purchase. You will hear people say don't average down, meaning don't buy the dip. If you already buy it, don't keep adding shares below and below. That's great if you are short-term trading, but remember, we are long-term swing traders, meaning we are holding this 6 months at least. So never go all in. You can average down to get the best price. The buying opportunity already presents itself because of what I'm about to show you next. Number 2 is wait for the 100-day and 200-day moving average. You may be asking me, what is a moving average? Great question. A moving average is just the average price movement for that particular stock. So as you can see, a lot of times it's trading above the 50-day moving average, which is great for those day traders or short-term swing traders to be able to make a lot of profit, right? But what we're looking for, we're just looking for buying opportunities on a larger scale because we don't have time to look at charts all day. We have our own businesses. We have our, our own jobs, 9 to 5. Some people have 2-3 different jobs. So this is really waiting for those layup plays. I go to my indicators and I just type in moving average. All right. And I have it here. You want to make sure your moving average is 50, and then you want to make sure that the next one is 100, and then you want to make sure that the last one is 200. What you want to do is to buy whenever the stock crosses below the 100-day or the 200-day. Here is one buying opportunity. And then we had another buying opportunity here in this zone. I'll just count this whole entire zone. And then, of course, we had another buying opportunity when the market crashed last year. All right. And then we have another buying opportunity here. And then the most recent buying opportunity, which I took these last two, is here. All right, the first thing that I notice is that every time the market comes below the 100-day or the 200-day moving average, it eventually goes back above. So this is the best time for you to buy your favorite equity stocks. When I say equity, meaning you are buying shares. You are not looking to buy options. If you buy options, you want to make sure that you are having a long-term expiration date. So equity is preferred, and so people don't get confused, buy shares. And if you don't know what options are, don't even worry about it because you don't need it. So like I said, it dipped below, it hit the 141 mark, and you could have sold, what was this? That was January, February, March, April. So about 4 months later, you could have sold at the 190 mark, or you could have sold way before it if you wanted to. And it's the same scenario here. This was just a bigger run up, right? This one didn't even come nearly as far down as the other one, and it came down to the 160s, which was fine. That is right below the 200-day moving average. We could have sold at the top at the 196 and then bought back again, and then sold it again at the 190 area, bought back again. So you see how this game is. You could have kept doing that, or you could have just bought this dip and just held for 5, 6, 7 months. And then my explanation here is that this is literally the most simplified version of trading. All you have to do is buy the dip, but not short-term dips. Remember that, not short-term dips. You want to buy the extreme dips. When we had the market crash last year in March, it's the same scenario. A lot of people got rich. not because the market fell. Well, for some people, because you can bet on the market going down, you can do that. But like I said before, you buy the dip. When it came underneath the 200-day moving average, let's say if you bought right at the 200, you bought at $200, and then it kept going. But remember, you didn't put all of your money in one play, so it came down a little bit more. And let's say you bought some more in the 190s, and then you bought a little bit more in the 180s, and it finally bottomed, in the 160s. But that's fine. From here, you just wait. You be patient, and then a whole year later, you could have took $1,000 and still turned $1,000 into like $50,000 if you held your favorite stock and then you sold at the right time. When people think the market is falling, especially like these last two times here, they thought the market was falling. It barely even nicked the 200-day moving average. So both times I bought the dip, I sold for profit up at the top once it touched the 330 area. And then I bought the dip again once I saw that it held the 300 area. So it's the same scenario over and over and over again. Literally, you can almost not lose, especially when you buy equity and you don't go all in at once. Thanks for watching. I hope this video has helped in any way. If it did, please like, comment, subscribe, share it to another friend. And I look forward to seeing you on the next video.